What's going on, social media fam? I got to be honest with you guys. I don't even know where to start. There's so much going on. First, with the Fed continuing to buy mortgage-backed securities, rates should be in an otherwise normal environment at all-time lows right now. However, there are a number of other factors that are not normally in play as a result of the COVID-19 virus and the rest of the abundance of volume that we have because of those low rates that are not really seeing that reflected in our rate sheets. Now, rates are low across the board, and here at Princeton Mortgage, they are very close to all-time lows. But they're still even here not as low as what they would normally be under similar circumstances. So let me kind of take you through the rest of the industry. First, we have a complete credit crunch or liquidity crunch in both the non-QM sectors, which is like the modern day version of subprime, although the loans aren't as risky as subprime. They're the loans that are not eligible for Fannie Mae and Freddie Mac, not eligible for other government programs. This non-QM bucket, non-qualified mortgage bucket, that market is under siege. The options are incredibly limited. And a lot of those companies may not make it through this because there's just the appetite in Wall Street is not there for those products. We've also seen real problems in the jumbo market. And so if you guys don't know, throughout the country, in most places, loans over $510,000 are considered jumbo. In some markets like New Jersey or Washington, D.C., there are super conforming limits that go up into the 700s. But loans that fit outside those loan limits are what we consider jumbo, and they're not government backed or government underwritten to government guidelines. And so there's a bunch of individual investors who underwrite to their own guidelines. And because of everything that's going on in the mortgage markets, the appetite for those products has really changed. Those rates are higher in comparison to normal government rates that we talk about here every day than really I can ever remember before the spread. And there's really concern because now those companies have to come up with their own guidelines for what they're going to do regarding appraisal issues from the virus, what they're going to be able to do with closing issues as part of the virus. So whereas Fannie and Freddie is kind of making these rules that everybody else is going to have to follow on normal loans, in the areas where we don't have those rules in place, people have to make up their own rules. And that sounds like it'd be easier, but it actually makes things harder. It also, because then there's less liquidity if you make a mistake or do something that other people aren't comfortable with later. You're kind of stuck with that stuff. So jumbo loans, really tough to get done right now. We did get some clarification, by the way, for self-employed borrowers through the agencies, which is that it's going to be on the mortgage companies to document in some way, which is kind of undefined at this point, that a self-employed person's income has not been disrupted by the virus, which even though we know in many cases it has. So there's some things going on there that are going to be tough to overcome. What just to continue on what we've been talking about all along here is there is a real liquidity crunch now across the mortgage industry where cash is going to be king. We've talked about how margin calls on these rate changes have made it so companies have had to come up with cash. We've talked about how early payoffs, which is people who maybe did a loan 3 or 4 months ago, are going to refinance now, and what that does to companies' servicing portfolios. In other words, they're planning on when they value the purchasing of a loan, they think they're going to collect payments on that on average for about 7 or 8 years. If they're doing it for 3 or 4 months, or even 7 or 8 months, that crushes the value of those portfolios. That's a real liquidity crunch. We are also just the liquidity that comes along with having more volume than normal, right? These companies are doing so many more loans than before and having to take those loans onto their balance sheets and to fund the warehouse line capacity for that. That's an issue. Now we have another issue, which is people not making their mortgage payments because either the government has said that they don't have to, or they're going to defer, or they just can't because of losing their jobs as a result of the coronavirus or COVID-19. Those individuals, those companies that are holding servicing, if they, especially on certain servicing pools, something called Ginnie Mae, which I can talk about another time, but basically Quicken Loans, Mr. Cooper, these types of companies, they're going to have to make the payments on those mortgage-backed securities, whether the borrowers make their payments or not. And they're going to have to come up with that money in cash upfront at the end of the month. And they may not have it. And so we don't know what that is going to do. So you have all these different buckets of issues in the mortgage industry for these companies that are making it so that if you are leveraged on your balance sheet with servicing, if you don't have cash, if your assets are tied up in other things, and we're seeing even with our warehouse line lenders, like they just, if you have a warehouse line lender, which is like the big credit card that companies like us fund loans on before we sell them off in the secondary market, those companies often have lines of credit with businesses. Well, those lines of credit are being drawn down on because businesses are feeling the crunch of this while we have all this extra volume in the mortgage industry. So there's just not enough money to go around, and no way anybody could have prepared for this amount of volume with all these other extenuating circumstances. And so that pressure, hopefully not, may put some people out of business. It's certainly going to create some opportunities in the industry for people that do have cash to take advantage of it. Good news for our borrowers or clients is that, again, rates are very close to all-time lows, especially if you fit into that non-jumbo category and your loan fits government guidelines, which most of the loan programs out there we're seeing right now do. And there's just going to be a lot more developments on this stuff. So, again, I think personally, I feel very fortunate. My company is positioned, our assets are cash. We don't have any servicing. We don't have, we have made all of our margin calls, and we have, the ability to do that. So I think that we're very well positioned, but I'm feeling for a lot of my other friends in the mortgage industry, a lot of them whom, by the way, don't get any information shared with them by their current companies. And so if they find out about this stuff at all, it might be because they're reading about it on some mortgage blog. There's just not a lot of information sharing at a lot of these other companies. But we're going to keep watching it day by day. And, this is why I keep, thankfully I have a lot of content to go over with you guys right now as we do these videos, but I appreciate you joining me through this. And if you have any questions, certainly reach out to me so I know I can answer them tomorrow. Thanks so much.